Imagine finding like a completely flawless, revolutionary company.
Okay.
I mean, we are talking perfect leadership, an incredible product roadmap, massive public goodwill, just a business model that is, guaranteed to change the world.
Sounds like a dream scenario.
Right. So you take your hard-earned money, you buy the stock, and over the next 5 years, you lose almost everything.
Yeah. Ouch.
It sounds impossible, right?
Yeah.
But today, we are going to unpack why finding a genuinely great company is actually often the easiest way to make a terrible, wealth-destroying investment.
It really is the ultimate paradox of the stock market. And honestly, it catches millions of people completely off guard.
Yeah.
So to understand why that happens and, how you can actually prevent it, we are doing a deep dive into the framework laid out in The Disciplined Path to Value Investing.
Which is such an amazing source.
It is. It's essentially an exploration of Benjamin Graham's philosophy. He's widely considered the father of value investing, basically the architect behind some of the most enduring financial strategies of the last century.
Right.
And the core premise we are looking at today, it strips away all that adrenaline of Wall Street.
Like the flashy stuff.
Exactly. I mean, this is not about day trading, and it's certainly not about getting rich by next Tuesday. It's a very methodical approach to building wealth slowly, safely, and intelligently.
Which is exactly what most of us want, right? But very few of us actually achieve it.
Yep.
And as I was going through the material, this massive realization hit me. We're totally conditioned to think the enemy of our wealth is external.
Oh, absolutely.
Like, we think it's the Federal Reserve or inflation or, I don't know, high-frequency trading algorithms, unpredictable global events.
Right. The big scary forces out there.
Exactly. But Graham's framework makes it painfully clear. The biggest enemy of the investor is actually the person staring back at them in the mirror.
It is a sobering thought, but it's completely accurate. Because the market itself, it's just a mechanism.
Yeah.
There's no malicious intent. There's no vendetta against your specific portfolio.
Yeah.
The vast majority of financial damage is actually self-inflicted.
Wow.
Yeah, it's just human psychology.
Yeah.
And to defeat that enemy in the mirror, you first have to be radically honest about what you're actually doing when you put your money into the market. Like, are you an investor or are you a speculator?
Okay, that is a harsh line in the sand. Let's unpack the difference there.
Sure.
Because the framework defines an investor as someone who carefully analyzes the business, plans for the long term, and focuses intensely on the safety of their initial money.
Right. The principle.
Exactly. Whereas a speculator is someone chasing a quick profit based on momentum or hype or just a gut feeling. But wait, let me push back on this a little bit.
Go for it.
Doesn't everyone speculate just a little bit when they buy a stock? Like, if I spend 3 weeks relentlessly researching a new AI tech company, reading their white papers, understanding their software, and I buy their stock,
Okay.
Graham would still call me a speculator if they don't have steady, predictable earnings yet. I mean, isn't that just being overly cautious?
It's a great question. And actually, that is a highly relevant distinction, especially today with all the tech hype. But yes, Graham would absolutely call that speculation, even with your 3 weeks of heavy research.
Wait, really? Why?
Because you are fundamentally relying on the future optimism of other people to drive the price up.
Oh.
You're just guessing that someone else will eventually pay more for that promise of future tech. You are not anchoring your decision to the current intrinsic value of the business.
Okay, let's pause right there, because intrinsic value is one of those phrases finance people throw around constantly.
They really do.
What exactly does that mean in this context? Are we talking about what the company actually owns or what the public thinks it's worth?
So intrinsic value is strictly what the business is fundamentally worth, based on its real measurable financial mechanics.
Okay.
It's completely divorced from its stock price. It is what the business would be worth if you stripped away all the hype, all the news, and just looked at the cold, hard math.
Right.
You calculate it by looking at a company's tangible assets. Their real estate, their inventory, their cash on hand. You subtract their liabilities and debts.
The actual stuff.
The actual stuff. And then, most importantly, you project the highly predictable cash flow they will generate over the next 10 or 20 years.
Yeah.
And you discount that future cash back to today's value.
I see. So an investor buys because that intrinsic value calculation is higher than the current price tag on the stock.
Exactly.
They're counting on the actual physical mechanics of the business to generate returns. Whereas the speculator is just, well, hoping the stock chart goes up.
That's it. That's the difference.
It reminds me of the difference between betting on a horse race versus buying the actual racetrack.
Oh, I like that.
Yeah.
That is the perfect way to visualize the mechanism at play here. Tell me how you see that playing out.
Well, a speculator is sitting in the stands betting on a horse. They might have studied the horse's pedigree. They might know its recent sprint times.
Right.
And they feel really good about the jockey. But at the end of the day, it's a single volatile event. If the horse trips, they lose everything.
No.
An investor, on the other hand, wants to buy the entire racetrack. They don't even care which horse wins.
Not at all.
They are analyzing the underlying business. Like, 10,000 people bought tickets today, 5,000 bought hot dogs. The track takes a 5% cut of every bet placed.
Yeah, the math of the whole operation.
Exactly. They calculate the revenue, subtract the cost of the maintenance and the stadium lights, and they know exactly what the business produces day in and day out.
Precisely. Owning the racetrack offers a structural safety that betting on a single race never could.
Right.
The investor demands safety of principal. The speculator, well, they're willing to risk their principal for the chance of a rapid spike in wealth.
Okay, so clearly we want to be the person buying the racetrack, not betting on the horses.
Highly recommended, yes.
But how do we actually negotiate the purchase of this racetrack when the owner of the business keeps changing the price tag every 5 minutes? Because, I mean, that is exactly what the stock market does.
It does. And this brings us to one of the most brilliant and enduring allegories in all of finance, which Graham used to explain the chaotic nature of the stock market. You have to imagine that you own a share in a business, and you have this eccentric partner named Mr. Market.
Right. And Mr. Market is, frankly, completely unhinged.
Totally unhinged.
Like every single day, without fail, he knocks on your door and offers a price at which he will either buy your share of the business or sell you his.
Yeah. But his prices are rarely based on the fundamental math we just talked about.
No, not at all.
Mr. Market is entirely driven by emotion. Some days, he is wildly euphoric. He thinks the economy is booming, there's absolutely no risk in the world, and he offers you a ridiculously high price for your shares.
And then the next day,
he is consumed by panic. He reads a bad headline. He thinks the world is plunging into a depression, and he offers to sell you his shares for pennies on the dollar.
And the crazy thing is, most people let Mr. Market dictate their own reality.
They really do.
If they open their brokerage app and see the prices are down, they feel poor. They absorb his panic.
Exactly.
And if the prices are up, they feel like geniuses. They're letting his mood swings become their mood swings.
Which is the exact opposite of what the framework suggests. Think about the mechanics of a real-world transaction here.
Okay.
If a manic, door-to-door salesman comes to your house every single day screaming about changing prices, what is your obligation to him?
I mean, I have zero obligation to him. I don't even have to open the door.
Right.
If he is offering me a terrible, panicked price for my business, I can just sit on my couch and ignore him. The ticker flashing red doesn't mean my business is failing. It just means my eccentric partner is having a bad day.
Precisely. The intelligent investor does not follow Mr. Market. They exploit him.
Exploit him. I love that.
Yeah. When Mr. Market is deeply depressed and offering to sell you parts of a solid business for significantly less than their intrinsic value, you buy.
Right.
When he is deliriously happy and offering to buy your shares for way more than they are mathematically worth, you sell. You use his irrationality to your advantage rather than letting it guide your own emotions.
Okay, so we have the discipline to ignore his crazy offers, but let's look at the other side of that coin. What happens when Mr. Market gives us a price that looks incredibly cheap? So we open a door, we buy the stock, and it turns out our intrinsic value math was just totally wrong. Like, maybe the company's management makes a fatal error the next month, or a new competitor wipes out their market share. How do we survive our own miscalculations?
That is the multi-million-dollar question. Because no matter how rigorous your analysis is, the future is inherently unknowable.
Right, you can't predict everything.
Exactly. Projections are really just educated guesses.
Yeah.
And the framework solves this problem with a concept called the margin of safety.
And this is essentially the buffer zone.
Yes.
So if you calculate that a company's stock has an intrinsic value of, say, $100 based on its assets and cash flow, you do not buy it for $95.
No, absolutely not.
Because there is no room for error there. You wait until Mr. Market is having a miserable day and offers it to you for $60.
Right. That $40 difference, that is your margin of safety. The mechanism here is simple. If your calculation was perfect, you make a fantastic return as the price eventually rises to meet the value.
Makes sense.
But if your calculation was off, if the company only ends up being worth $80 instead of $100, you still don't lose money because you only paid $60.
The source notes actually compare it to the engineering of a bridge, which I thought was brilliant.
Oh, yeah.
Like if you know a bridge is going to regularly carry trucks that weigh 10,000 pounds, you don't build a bridge that can hold exactly 10,000 pounds.
You'd be crazy to do that.
Right. You build a bridge that can hold 30,000 pounds. Right. The margin of safety absorbs those unexpected shocks.
Yeah. And that leads directly back to the very first scenario we discussed today. Why is it that you can find a flawless, world-changing company and still lose all your money investing in it?
Because valuation matters. This was honestly the hardest pill for me to swallow. A great company and a great stock are two totally, entirely different things.
That's exactly. Let's break down the mechanics of why that happens.
Yeah.
If a company is universally loved, if everyone knows their products are amazing and their leadership is brilliant, then Mr. Market is going to price that stock for absolute perfection.
He's going to demand an astronomical price for it.
Yes.
So if you buy it at that euphoric price, all of that company's future success is already baked into what you paid.
Right.
They have to perform flawlessly for the next decade just to justify the price you bought in at.
And what happens if they stumble? What if their earnings grow by 15% instead of the 20% everyone expected?
People panic.
Yeah. The company is still growing. It is still highly profitable. It is still a great business. But because you paid a price that demanded perfection, the stock price will collapse.
Because you violated the margin of safety.
You bought an amazing business at a terrible price. Always compare what you pay to what you actually get.
Okay, so we need to demand a margin of safety, and we know we have to hunt for these mismatches between price and value. But let's be realistic here. Finding those mismatches, doing the math on tangible assets, reading balance sheets, predicting cash flows, that sounds like a grueling full-time job.
It really can be.
So how does the average person actually execute this?
Well, Graham was very realistic about human behavior and time constraints. He divided true investors into two distinct categories.
Okay.
The defensive investor and the enterprising investor.
Yeah.
You basically have to decide which one you are based on your willingness to do the work.
You know, it reminds me of the difference between how people approach cooking dinner.
How so?
Taking the defensive investor approach is like subscribing to a high-quality meal kit delivery service.
Okay, I see where you're going.
It's structured, it's consistent, and it gets the job done safely. You know, you are not going to win a Michelin star, but you are going to eat a nutritious meal every night without spending 3 hours chopping vegetables.
I love that.
Yeah.
So in financial terms, how did that meal kit approach actually look?
It looks like extreme simplicity. The defensive investor relies heavily on broad index funds to capture the growth of the overall market.
Right. Keep it simple.
And when they do buy individual stocks, they stick strictly to massive established companies with decades of stable earnings and a long history of paying consistent dividends.
The boring companies.
Exactly. Think utility companies or consumer staples, the companies making toothpaste and laundry detergent. They are boring, they don't grow very fast, but they are incredibly reliable. The whole goal is to protect against inflation and participate in the economy's growth with minimal effort.
And then you have the enterprising investor.
Yeah.
To use your analogy, this is the person who wakes up at 5 in the morning, goes to the wholesale farmer's market, haggles over the price of obscure ingredients, brings them home, and cooks a complex, multi-course meal entirely from scratch.
Right. Higher effort and potentially a much better payoff if you pull it off.
Yep.
The enterprising investor is the one digging through the financial footnotes. They are looking for distressed assets, companies going through temporary scandals, or special arbitrage situations where the market has deeply mispriced a stock.
Right. They are putting in the hours.
But here's the catch. If you go to the farmer's market and buy all those exotic ingredients, but you don't actually know the mechanics of cooking,
Yeah.
well, you are just going to burn the house down.
And that is the danger zone where most people ruin their wealth.
Yeah.
They want the returns of the enterprising investor, but they aren't willing to do the grueling mathematical homework required to find true intrinsic value. So they end up just guessing.
They become speculators again.
Exactly. They revert to being speculators, but they trick themselves into thinking they are enterprising investors.
Oh, that's dangerous.
Very. Graham strongly advocated that the vast majority of people should choose the defensive path. Accept average market returns, keep your costs low, and focus your energy on your actual career.
So, whether you choose the meal kit path or the scratch cooking path, there is one final overriding principle that determines if you actually survive the process.
Yes.
And this really blew my mind because it has absolutely nothing to do with whether you went to Harvard Business School or if your IQ is 160.
Right. The final tenet of the framework is behavior over brilliance.
Behavior.
Yeah. You can be a mathematical genius, totally capable of calculating intrinsic value down to the decimal point.
Right.
But if you cannot control your own emotional impulses, you will be destroyed by the market.
Because of the cycle of fear and greed, right?
Exactly.
Humans are biologically wired to follow the herd. When everyone else is making money, greed takes over. We want in on the action, so we buy when prices are at their highest, and that margin of safety is completely gone.
Yep.
Then, when the market inevitably corrects and drops, fear takes over. We panic, we sell our shares at a massive loss just to stop the pain.
And that leads to a mathematical reality that investors often fail to grasp. The math of losing money is incredibly unforgiving.
Break that down for me.
Let's look at the mechanics of a major loss. If you start with $100,000 and you lose 50% because you panic during a downturn, you are down to $50,000.
And here is the brutal part. To get back to where you started, you don't just need a 50% gain.
No, you don't.
Because a 50% gain on your remaining $50,000 only gets you to $75,000. You need a 100% gain. You have to literally double your money just to break even.
Exactly. Massive losses permanently cripple your wealth's ability to compound over time.
Wow.
That is why the framework stresses that you don't need to make brilliant, genius-level predictions to succeed. You just need to systematically avoid huge mistakes. You have to protect your initial capital first and foremost.
So essentially, to be a legendary investor, your ultimate goal is to be perfectly, unemotionally boring during times of sheer chaos.
Yes. When Mr. Market is screaming on a roller coaster, the intelligent investor is sitting quietly on a park bench reading a book.
I love that image.
They expect market fluctuations as a natural feature of the system, not a bug. They stay calm during the downturns, knowing they bought with a margin of safety.
Right.
And perhaps even more importantly, they avoid overconfidence during the booms. They let the mathematics of long-term compounding do the heavy lifting, rather than trying to outsmart the system with short-term trades.
It really is a profound way to look at wealth. This isn't a competition against the day trader next door or some high-powered hedge fund in New York.
No, not at all.
It is an internal discipline. If you can focus on intrinsic value rather than price, if you demand a margin of safety on every purchase, and if you measure your progress in decades rather than days well, the math works in your favor.
It really is a framework for self-mastery disguised as a framework for finance.
Yeah.
Which brings us to perhaps the most famous quote from Graham's work, summarizing everything we have covered today. The intelligent investor is a realist who sells to optimists and buys from pessimists.
A realist, not a cynic who thinks the sky is always falling, and not an unchecked dreamer who thinks trees go to the sky.
Exactly.
Just someone deeply anchored in the actual mechanics of reality. It is an incredible approach to navigating the financial world. And it actually leaves me with a final provocative thought for you listening, and it extends far beyond your brokerage account.
Oh.
Yeah. Think about this. If the key to massive financial wealth is entirely based on mastering your own emotional reactions to an erratic world, if success is defined by ignoring Mr. Market's moods and staying anchored to intrinsic value, it makes you wonder.
What's that?
How much wealth in your personal relationships or your career are you losing right now simply by reacting to other people's emotional highs and lows? How often are you letting the enemy in the mirror dictate your long-term happiness instead of relying on your own internal margin of safety? Something to think about.